I've naively typed in profitable trading strategy and immediately I get shorts that look like this: 100% win rate on $1 million account. Crypto millionaires revealing his money printing, strategy with a 95% win rate, whatever that means. Some of these people are talking about how you have to quit your day job for any hope of making it in the trading space. Just scrolling on down a little bit here, you can see the the only trading strategy you'll ever need. It's an 8-minute video. It's got 1.2 million views. We're back in our Jupyter notebook here, and the goal is going to be to develop this framework for understanding the trading space by taking a look at gambling versus poker and trading, taking a look at two different scenarios for day traders, one where they're trading with net zero EV and one where they have net positive EV. Let's begin with this idea of gambling. Now, gambling is fundamentally different from poker and trading. The reason for that comes down to this idea of edge. Any sort of game that has a house edge, where when you play it, statistically, you are destined to lose money, that is gambling. It has negative connotations because no matter what you do, there is no optimal decision to make. The outcome is fully governed by some sort of probability mass function, and your expected value playing the game is always going to be negative. And this is true for things like roulette. This is true for things like the Powerball. If you buy a lottery ticket, your value is net negative. So if you continue to play this game, then statistically you will go bankrupt. And this doesn't say anything about one person's wealth path. It says something about the general trend of wealth paths over a series of plays. So what I have here is a chart of people playing roulette at a casino. And what you can see here is this purple path actually does pretty well, right? This purple path makes almost $10,000, but everyone else is consistently losing money. Now, what happens if they continue to play? Well, take a look at what happens to everyone's wealth paths. Eventually, everybody ends up at this net zero wealth, and some even go negative here. So this is the idea of gambling. No matter what you do, your decision is not going to influence your expected value. There is no optimal decision to make. Now, each outcome itself is random. So in the short run, you may actually end up net positive. And you could stop playing before you actually accumulate a loss. But that turns into the gambler's room problem. And I have a video on that if you'd like to check it out. But the moral of this story is gambling has negative connotations. Rightfully so. How is poker and trading any different? It's just gambling too, right? Well, no. They deal with uncertain outcomes, sure, but their outcomes aren't governed by a fixed probability mass function or density function. In this case, the concept of expected value still applies, but your action or inaction, whatever policy or strategy you're using, directly contributes to your expected value. And the tricky thing about this space is just because it's difficult to learn a policy to play optimally, it doesn't mean that there's negative edge against you and that's fixed. It's a very, very critical distinction, because if you look at poker bots, right, they can statistically outperform pretty much any average player. And you could argue that what? It's just random and poker's just random and it's just gambling, but why are those bots able to consistently outperform? They're clearly learning something, and that's what they're learning. They're learning how to optimize for EV. In fact, poker is a very particular case of this, because you don't even need to act with net positive EV. What I have is some players, 2, 3, and 4, who are just betting naively. They're betting randomly, and of course, over time, they're eventually going to lose all their money, just like in the first example. But what happened to players 0 and 1 here? They're starting to accumulate all this wealth, and eventually over a large number of plays, what happened? They accumulated over $1 million each. Well, that's because they're learning the optimal policy for this modified roulette. In this modified roulette, if it lands on red, then the next time around, it's more likely to land on black, and vice versa. So these two players were able to figure out that optimal policy, while everyone else was acting suboptimally. This is what changes the entire dynamics of the system. It's no longer a fixed probability mass function. Yeah, of course. 100%. There absolutely is. But there are several considerations to discern whether or not it is skill or luck. This is not a trivial problem. A simple argument using poker bots shows you that it is possible to learn some sort of optimal policy to act with net positive or net zero EV. We're ready to approach this idea of day trading. And what we're going to do is we're going to look at a simulation of 100 day traders, and I'm going to say each one of them is essentially trading a net zero EV strategy. So this is very generous. It's saying, hey, their strategy overall is just net zero EV. They're going to break even at best in the long run. Again, this is not a comment on ergodicity. If it was, in fact, this argument would go in my favor to an extreme. So we're going to focus on this more ergodic example. But again, if you're interested in that topic, go check out my other video. The implications are kind of crazy of this simulation. So I have 100 day traders, they're trading 1,000 times, and you could see some finish up here with over an 80% gain, some finish with over an 80% loss. And there's no difference between any one of these traders. They're all trading the same strategy. It's a net zero EV strategy. 100 students, and all of them trade this crappy net zero EV strategy. Some are going to accumulate a crazy amount of wealth. In fact, if the system is non-ergodic and there might be a slight positive edge in some cases, then some people may experience extreme wealth on the upside while everyone else experiences accumulated negative EV and terrible wealth. And what this is just survivorship bias. Here we're looking at a positive expected value. So 100 traders are trading a winning strategy, and they have a 52% win rate with the same amount earned versus risked on each trade. So you'll see a positive drift here. This white dashed line is no longer just net zero slope. It actually has a positive slope. And sure, the implications are the losers aren't going to lose as much and the winners are going to win more. But in this context, I've seen absolutely crazy statements. There was a day trader who I was watching not too long ago as I was investigating into two other traders in this space, who cited the central limit theorem for his futures trading strategy, that if you just continue to trade in an intraday capacity, that, you know, eventually your strategy is going to converge to this mean profitability. And it is so wrong, and it applies the theorem in such an incorrect way. It was just unbelievable to watch, and people don't know what the central limit theorem is, so they believe it, and it is just outrageous. So here we have a case of positive drift. We have all of these traders trading 1,000 times, 100 traders trading this net positive EV strategy. Check it out. 32 out of 100 finished with over 50% returns. But this is generous. How many traders experienced a drawdown of greater than their initial principal? 94% in this set of sample paths, 94 of the 100 traders lost money below their initial investment at one point throughout this simulation. So what's the deal here in reality? Well, institutions don't go about constructing strategies in this way. When you approach some sort of day trader or some sort of, you know, crypto millionaire or whatever they want to portray themselves as, if you propose time series regressions, Fama-Macbeth regressions, the distinction between statistical mispricings and priced risk, they would have no idea what you're talking about. The quantitative research methodology that goes into developing these institutional grade strategies, they have no idea what that looks like. They have no idea the series of iterations that you go through, acquiring data, cleaning, pre-processing it, developing this this data pipeline backtesting engine. After studying quantitative finance at the undergraduate and graduate level, master's, PhD, I was not satisfied with the transition from academia to industry, which is exactly why I built quantguild.com to help you master your quantitative skills for roles as a trader, a market maker, or a quant in the financial services industry, with an adaptive practice engine that scales with your skill level so you can progress to more and more difficult topics. Over 100 hours of lecture content taught by myself, everything from A to Z. We're talking about first principles to the postgraduate level in coding, stats, math, data science, research. The list goes on. Quant Guild is the platform that I wish I had when I was coming up to be a quant, and that is exactly why I built it for you guys. So if you're looking for roles in the financial services industry as a trader, a market maker, or a quant, check out quantguild.com to master your quantitative skills.